But as promised, an exclusive chat between Surendra Goyal of Citi and ETNA's Nikunj Dalmia on earnings growth, valuations, finding merit in the market, all of it. Listen in.
While all of us are very focused on India, what is happening is you have seen EM as an asset class have a decent recovery. Okay, so while India has done well, it's up say 5-6%. Over the same period, EM has actually done even better. So I would just say that what is happening in India from a market's perspective, a large part of it is EM driven, flow driven. If you see in India this year, year to date, FII flows are $12 billion. Domestics have been getting money every month, which is getting deployed into the market. And then you have some bit of EPFO allocation into equities. So all of that is resulting in a decent flow. So that is what is really been a big driver of the markets. So your question is absolutely valid. Growth is slow. Most of the indicators are not looking great. But I think flows is what is really supporting this market.
Is it a good idea to judge the market based on flows? Because ultimately investors who are investing, whether it's HNI investors or institutional investors or hedge funds, they want returns. Returns would be a function of earnings. So somewhere, do you think this entire thought will certainly start coming back that why are we investing in India? Because valuations are high and earnings are not there. So markets and prices will not go higher.
So maybe I think 2 or 3 things that you will have to look at. I think firstly, the earnings outlook. So what has been happening in India is while earnings have been disappointing, the next 12-24 month outlook always looks good. People are still hopeful that on a low base it will recover. So that at times does support the market. Secondly, I think even from a flow perspective, you'll have to step back and see why are flows coming. Okay, so and a lot of times the answer might be that the other asset classes where an investor can go into is also looking equally tough or worse, right? So I think a lot of those questions put together will be an answer to that question. But flows is always an important part of the market, particularly from a short-term perspective. So the point I was making is that is what has resulted in the return so far, despite the macro looking tougher. And which is why sitting where we are, our September next year target on the Sensex implies pretty much very limited or almost no upside from here.
Okay, let's look at that Sensex target. It'll just come up on your screen. I just will take a a backdrop, which is that your projections is that 39,000 could become 40,000. It is a target which is based on the fact that we are going to have a flat earnings growth. The bulls would say that you're conservative. The bears would say that at least you're not making a case that 39,000 will go to 36,000. So what is the good news here and what is the bad news here?
Yeah, so I think, see, the bad news over the past few years has been largely earnings, and again, the macro, etc., everything kind of finally filters down into earnings. So that has been tough. We all know that every year the bottom-up expectation is 20% plus on earnings growth, and we end up with single-digit growth. And that has continued this year. This year also we are now expecting a pretty muted growth. So that has been a challenge, and at least in the foreseeable future, it doesn't look like a very steep recovery is coming. It could be better than what we end up with this year. Next year could look a little better, but I don't think we'll have the kind of growth which bottom-up or consensus is already penciling in. On the positive side, I think what is driving the market is that there have been fairly sticky flows. Right, the SIP flow, despite all the negativity that we keep hearing about, has held up in a very narrow band, 8,000 crores give or take, right? Foreign flows this year, again, it's partly EM flows also coming into India, that has been strong. So that is what has been supporting the market. But clearly from an earnings perspective, I think the only comfort one can draw from is when you look at some of the indicators like earnings to GDP, etc., we are at depressed levels. But those indicators, it's difficult to call when the turn happens. So we are at depressed levels, but really when it plays out is something which is turning out to be very difficult to call. I have seen people take this bet 3 years back, 2 years back, 1 year back, and so far it's not really played out.
Something or the other has gone wrong in last 3 years. 1 year it was demonetization, then it was GST, then it was IL&FS. Do you think this is the first time we're getting a clean year of earnings?
So I think when you say clean year, okay, even this year when you are looking at least reported earnings, there are a lot of moving parts, right? Firstly, the commodity sectors are pretty weak. Okay, so you look at both on the oil and gas side as well as on the metal side, those sectors are looking pretty weak on earnings. On telecom, you know the issues, right? Which at least from a reported earnings perspective, the earnings could look very different compared to what we started the year. So what is happening is every year we have a bunch of one-offs, and which is one of the reasons, like if I go back last 5 years, you had a couple of years which were tough on commodity, 2 to 3 years which were tough on financials because of higher losses, etc. So that has been the case. Now it does look like next year should be a clean set of earnings, but then again it's difficult to call because even last year we felt the same way.
Okay. What if I again look at the earnings for the quarter one? It was a tough quarter. Slowdown at every level of the economy was visible. Autos, consumer durables, even for NBFCs, and for that matter even for sectors like media. But if I look at the good bit here is Bajaj Finance managed to grow. HUL numbers were good. There was growth which was projected by major FMCG companies also. So you think this entire migration of markets towards 10-15 stocks, which may be called as a very narrow market, a very concentrated market, that is here to stay because that's where earnings are?
So I'll just make 2 points there. Firstly, while the earnings are not great, obviously we have of BSE 100 is kind of flattish YOY if you are looking at PBT, and I'm focusing on PBT because corporate tax has really changed. So, but compared to the expectation that we had, it was minus 5%. So it's better than what was expected, and large part of that has to do with margins, where I think either analysts underestimated and things have turned out to be a little better. So I think this migration thing that you are talking of, that has been a big challenge for investors over the last many years now, right? And the number of stocks possibly keeps shrinking. It's a very, very narrow set. Now, if you're looking at from a near-term perspective, what is happening is overall earnings growth is muted. The macro is looking tough. So there are those handful of stocks which are delivering. So a lot of money is migrating into that. But I think if you take a 3-year view, and you would expect that some of the challenges that we are going through, there will be recovery and things should improve. I don't think that trade may necessarily play out. But in the near term, I think that is what is going to happen. If you see mid caps versus large caps, the same trend is very visible. Everybody wants to hide in a select set of mid caps, and which is why mid caps, which were at a large caps, which is why mid caps were at a premium 1.5 years back, are now at a significant discount.
Every time when the sector, the economy comes back from a slumber, there is one large profit pool which gets created. It was cement and, some would argue, cement and IT, let's say in 80s and 90s. It was followed by TMT. Then came the time of what happens in infra companies. Then came the time of consumption, NBFCs and private banks. On a 5-year basis, if India has to indeed become a $5 trillion economy, which is one large profit pool or group of companies or group of sectors or group of businesses which will take the earnings higher and India's GDP higher?
So I think you can, the time frame is a little difficult, but I think you can look at this question in 2 ways. One is if you see the last 10 years, one part of India which has been particularly subdued or earnings have been depressed is industrials, infrastructure, capital goods. And I don't think any of us will argue that the country needs a lot more of it. So if things normalize, I think that's 10 years of slowdown eventually should see a nice recovery. So that part of the profit pool could become a lot bigger 5 years, 7 years later. And as I said, timing is always the most difficult thing on these calls. And when you look at the medium term opportunity, particularly from a listed space perspective, internet is a big sector or segment in a lot of markets, right? And we are still at an early stage. So if you're looking at 5-7 years down the line, again, depending on how the sector pans out, there is an opportunity that it could be a material sector. If you look at some of the other markets, even real estate is actually a much bigger part of the benchmark. And India, I don't think, again, anybody would debate that India needs a lot of housing. No, does it happen in the listed space, unlisted space? It's a very fragmented market. Does it consolidate? All those are questions. But I would say this kind of spaces could actually have the potential to be meaningfully bigger 5-7 years down the line. And then again, consumption, I'm not mentioning it because it's an ongoing theme. It's been playing out. So it's not new, but I think there is a room for that to continue delivering.
Let me preempt a question which I'm sure clients ask you on a daily basis. Surendra, let's divide Indian companies into 3 brackets. The compounders and the evergreen companies, which would include an HDFC Bank, some financial names and consumption names. Companies where distress is currently available. It could be sentiment, it could be a business cycle. And companies where right now the groundwork has been done, They are small and mid cap right now, but they have potential to become large. You know what happened in Bajaj Finance, or what happened in HDFC Bank 20 years ago, or HDFC Limited 30 years ago. The first list we all know. The second list and third list is where curiosity is high. So what qualifies in a second list and the third list?
So I think, see, in the second list, what we typically look at is companies where the business cycle is not working out. Okay, but then they have a reasonably decent balance sheet to tide over this period of uncertainty. Because if these things are in place, whenever the cycle turns, you should see a good upside. And then the risk reward really looks good, that yes, near term there could be pain, but then whenever the cycle turns, you could get a lot of upside. So that good balance sheet is very important, at least an ability to tide over the current distress situation is very important. And business cycle, because wherever we think that there is a governance related issue or red flag, we would rather avoid. So that has been the thinking, and if you see our model portfolio, that has been the thinking around it. The third one I think is always trickier. While all of us like to talk about HDFC and Bajaj Finance, whatever the name is, right? But then identifying those companies and sitting on that for 15 years, 10 years, I think that's a really tough thing to do for any portfolio manager.
Some of your model portfolios will just come up on your screen. Again, this is public information, so we're not sharing anything which is completely, which is not available in the public domain. I'd like to draw your attention to the corporate governance challenges which India is facing. And the reason why Indian markets commanded a premium is because foreign investors always said that, look, we like to invest in India because India has got great companies and our corporate governance standards are much better than Indonesia and China. But guess what? A lot of companies have got compromised there. Good companies, good groups, good brands. Could this be an impediment now?
So I think when we talk to a lot of foreign investors, for them, for a lot of them, the Indian market was about 30-40 stocks, which is what their universe was and which is what was investable for them. And there again, you have not really seen a big change. Okay, there could be one or two cases where companies have come under stress, but there are still enough good companies to invest in. And which is why when I talk to foreign investors, there is always an appetite for India. Given valuations, it could diminish a little. Given the macro, it could diminish a little. But from a 3-5 year perspective, is their interest in India lower than what it used to be? I don't think that is the case.
I'd like to draw your attention to private banks. That's really been the most cozy and perhaps the best trade for last 20 years. I mean, whichever way I cut the timeline, private banks have made money. Next 5 to 7 years, do you think private banks run the risk of giving single-digit returns? Because they've given CAGR returns of 20%, 15% plus for almost 17, 18 years now. For next 10 years, do you think private banks will make money, but they will remain underperformers or market performers?
So I think there are two questions there. One is, if I take a 2-3 year view, I still think this kind of returns can continue, because firstly, purely from a market share perspective, there is enough opportunity. Okay, and which is what has been the driver for the stocks, right? If you see, if you can compound at 15-20%, typically the market cap is compounded either faster or at the same rate. So at least from a 2-3 year perspective, I think there is still that opportunity to keep on doing that. Again, as a group, there will always be some who do better and some who do worse. In terms of anything beyond that, or even 2-3 years or 5 years, I think it's also a function of when the rest of the market recovers, right? For example, as I was talking about private capex earlier, we have had 10 years of weak numbers. So if actually we end up seeing a recovery, say 2 years down the line, 1 year down the line, again, difficult to call, but if we see a recovery playing out, then you will see some of the money which is hiding in these names will start flowing towards that. And that is the period where these stocks could potentially give you lesser returns.